88% of actively managed large cap funds have underperformed the popular indices Sensex and Nifty in this 7-year period. No doubt, passive funds are gaining popularity. And if you are looking to invest in a large cap fund, passive funds can be a good option. But where you might get stuck is choosing between the two popular large cap index, Sensex or Nifty 50. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance and investments. So in this video, we are going to compare the two popular large cap index, Sensex and Nifty 50, and try to answer which of these indices is better for your investments. So let's get started. For new investors, very quickly, let's understand what active and passive funds mean. If you already know the basics, you may jump to the next section. So, active funds are the ones where the fund manager actively manages the portfolio of the fund, which means the fund manager decides where to invest and what to sell from the portfolio of the fund. Of course, within some preset guidelines. However, passive funds are the ones where the fund manager does not take the buy and sell decisions. He rather tries to mimic or track the index to offer the index-like returns to the investor. So understand it like this. If a stock is added to the index, the fund manager adds it to the fund's portfolio. And if a stock moves out or its allocation is reduced, the fund manager mimics the same for the fund. Now, let's start comparing Sensex and Nifty 50. Launched in January 1986, BSE Sensex is the oldest stock index of India. It measures the performance of the 30 largest, most liquid and financially sound companies across key sectors that are listed on BSE. On the other hand, Nifty 50 was launched almost 10 years later in April 1996. The index represents the top 50 stocks by market capitalization. So clearly, the first differentiator between the two indices is the number of stocks they are made of. Now let's look at their portfolios to dig deeper. Both the indices are large cap indices, therefore all the stocks are large caps. Both indices are free float market cap based indices. Now free float market capitalization means the valuation of a company depends only on the shares held publicly. So while selecting the largest stock for the indices, only those shares that can be traded were considered. Also, the weight of the stocks in index is decided by the free float. So higher free float means higher weight in index and vice versa. On your screen are the components of Nifty 50 index along with their weight. So Nifty 50 has 50 stocks and top 30 stocks that are also part of Sensex that account for around 86% of the portfolio. This basically means that the remaining 20 stocks in Nifty 50 account for a meager 14% of the index weight. Also, this means between Sensex and Nifty 50, the majority, that is 86% of the portfolio, is the same. So, let's see how the similarity between the portfolios affect the returns of the two indices. So the two indices have moved in tandem over the long term as far as their returns are concerned. Look at your screen. Here what we did was we rebased Sensex TRI and Nifty 50 TRI index to 100. We have taken the monthly index values since July 1919 and you can clearly see the two indices are overlapping each other. Even when we looked at the rolling returns, the difference wasn't much over the long term. We took the daily rolling return of the two indices over different time periods, 1, 3, 5, 7 and 10 years since July 20, 1999. The data of Nifty 50 TRI is available for 10-year rolling returns since this date. Now, rolling returns is like calculating trailing returns, assuming you are investing on a daily basis. Or you can say that it is like a daily SIP for a certain interval and then taking an average of the series of returns. So we got thousands of such instances. We have taken the average, maximum and minimum values of these instances. Over a 5-year period, Nifty 50 TRI has delivered 12.52% CAGR, while BSE Sensex has delivered 12.85%. The difference is a few basis points. For the uninitiated, 100 basis points is equal to 1%. Similarly, over a 7-year period, Nifty 50 TRI has delivered 13.78%, while Sensex TRI has delivered 12.80%. Now coming to 1, 3 and 5-year periods, we could not spot any clear trend. Sensex has done slightly better, while on the other hand, over 7 and 10-year period, Nifty 50 has delivered slightly better returns. Again, despite Sensex having 30 stocks against Nifty's 50, the difference in performance is not significant. Now comes the big question. Which of the two indices should you choose? As there is not a significant difference in the performance of the two indices over long term, investors can choose to invest in any of the two indices. There are many index funds launched by fund houses replicating the portfolio of these two indices. Always choose the fund which has delivered returns close to the indices. You can check the tracking error of the different index funds and choose the one with the lowest tracking error. Tracking error is the difference between the returns given by the fund and the index. So it's a wrap. If you liked the video, subscribe to our channel and share the video with your friends and family as well. And we'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.